Good morning, everybody. This is Real Estate Cody, and this is the Prosperity Through Multifamily Real Estate Investing Podcast. Glad you're joining us today. Before we get into the show, if you have not done so already, make sure to go check out our latest acquisition. Make sure to check out Hollister Oak Apartments. Visit us at www.blueoakinvest.com/Hollister Oaks. If you want to take an opportunity to take a look at that, the subscription is filling up very quickly, and we want to make sure that we get you in if you're interested. So if you want to get into that opportunity, make sure to visit www.blueoakinvest.com/Hollister Oaks. With that, we have a very special guest on the show, Mr. Nic Espanet. Nic is the founder and CEO of Thrive Multifamily. He has 5.5 years of experience with multifamily real estate, 9 years of experience as a small business owner, and 24 years experience managing physical therapy teams. So with that, Nic, welcome to the show.
Hey, Cody, I appreciate you having me on. I'm excited to sit down and visit with you today.
Man, I'm excited to connect with you as well. I know, Nic, we met back in, I think, 2019, late 2019, at a real estate conference in Dallas. And at the time, you had already had a lot of success and momentum up to that point. But, man, you've been off to the races since then. So I'd like to kind of start right there, man. Tell the audience a little bit more about your background and how you found yourself in multifamily real estate.
Sure, I appreciate it. This year has been an exciting year, but I went to school to be a physical therapist, and then around probably 2015, started looking more for something to do with my retirement. My wife and I were not happy with the stock market and wanted something that we could be more hands-on with, and honestly, just be able to understand a little easier. And so we started looking at single family investing, but we kept coming across multifamily stuff as we were educating ourselves, and ended up at a conference and joined a group that more of an education and investment group. And, it took me about 1.5 years and was able to syndicate my first deal, which was a 100-unit property in Abilene, Texas, which if you guys aren't from Texas, is about 2 hours west of Dallas-Fort Worth. Population of about 125, 130,000. But, we started looking in secondary markets just to, at the time getting started, we weren't getting much traction in DFW. So we started looking at secondary markets in Texas with a population of over 100,000 and with more, at least three or more economic drivers and, positive job growth and positive population growth. So that was kind of my first deal. And then we did close another one 10 months. And you want me to go? I can go through the whole history from then to now, or you want to save that for later?
Yeah, save that for later. We'll get there, man. Because I know that you've done, like I said, you've had a lot of momentum since that first one, and you've had a lot of success. And so we'll definitely touch on that. But I kind of want to go back and kind of pick at your experience as a healthcare worker. I think that's a similarity that you and I share. I'm a registered nurse. You come from a physical therapy background. And we talked about that. You spent a couple of decades in physical therapy, 24 years or so, roughly. And, one of the things that we love doing, just from my background, is appealing to healthcare providers, because as you mentioned, I think healthcare providers are very intelligent people, right? They're highly educated people, and that's across multiple disciplines. But when it comes to financial literacy, we discuss this all the time, where there seems to be a lack of financial literacy and education when it comes to, like you mentioned, how do you preserve your long-term wealth? How do you really position yourself for a nice, comfortable retirement? And the reason this is so important to me personally is because, as you know, is as healthcare providers, we give our everything to taking care of other people, right? Physically, mentally, we give everything that we have to caring for people, and it takes a special person to do that. But we don't give ourselves that same attention. And hey, kudos for you to figuring this out in 2015 of like, hey, there has to be a better way to do this. So I kind of want to start there. Tell me a little bit more about, that transition and that discovery of realizing that, just being that physical therapist for 40, 50 years isn't going to get you the lifestyle that you were hoping to achieve.
No, I could see the writing on the wall. As I was getting older, physical therapy can be a little more physical demanding, and just as nursing can, if you're moving patients and lifting people. Now you can get in more into the administrative side and not have to do that. But there are days when I was at the time, my low to mid 40s, like, I can't imagine doing this when I'm late 50s into my 60s, or even, in my 70s, if we're still needing to have an income at that time. And then I was blessed that my wife's father has a small apartment complex and has done different real estate. He's got, commercial lots or just vacant lots or single family homes, and just talking with him and seeing what that, what that, created for him, got us started more. And, just that's kind of started me down that line. And like you said earlier about, healthcare providers, we generally don't get, there's no requirement for any type of financing or economics. So, my friends now that have kids going into healthcare or medicine, I'm like, tell them to take at least one or two economics classes, a finance class, something to get this ball, have some education on it in some other way. It's and it's not, as a healthcare provider, you make a decent living, but you're never going to become wealthy. And I had the thought, if especially having children, if I break my leg or do something I like to do, mountain bike and do some stuff, if I crash on my bike and can't work for 2 months, then we're not going to. I mean, yeah, we have disability and those things to back it up, but I don't like depending on something like that. A great thing about real estate in general and multifamily is you get it's the passive income we're all looking for, to where you can be laid up for 2 months or take a vacation for 2 months and you still have income coming in.
Yeah, that's such a great point, Nick. And I know I was a personal, like I call victim of that, where I had a back injury myself early 2020. I was out for a month, and like you said, we had benefits and stuff to cover that. But if you put that into perspective, if that was a long-term injury and I was going into this for 6 months, a year, or whatever, that would be a substantial decrease in my income. And that was a really, powerful moment. I was already working on multifamily real estate, but it was even more of a powerful moment just to realize that, like this is a real scenario where, like you said, healthcare providers, especially as they get older, they've been doing this for a long time. Your body starts to break down. You're more prone to injury. And that can take a really significant impact on not just your physical health, but your financial health. So very good point there. Now, after making this transition, because it's my understanding, if I recall correctly from the last time we talked, you're full-time real estate. You were able to transition out of physical therapy altogether. Since that transition, have you found that people within your community, healthcare professionals in particular, have drawn to you or started being intuitive about what you're doing and why you made that transition?
A couple. I was doing the last 7 years, I did contract home health. So it's a much more solo, you're not interacting with colleagues very much. So not, I've had one or two reach out and want to know what I'm doing, but it's still, you can lead a horse to water, but you can't make them drink. I'm kind of just letting them see. And you got to, when somebody starts showing interest, that Rich Dad Poor Dad book, just trying to get a different perspective on how money works, and instead of working for money, getting the money to work for you type thing. So it hasn't been as much as I'd hoped, but it's slowly, I think, coming around as they're seeing success, seeing I haven't, I think a lot of them expected me to be back knocking for my job into it. And it's, I still, one of the guys that I worked with, and he has a little contract company. I see him when I work out, and he'll about once a month say, hey, he'll ask, are you ready for some patients? Did you lose me for a second, Cody? My screen went away for some reason. I don't know what I did.
No, you're
back. Okay. So he'll ask me if I'm ready to take patients, and I just very nicely say, no, thanks. But, at the time we're working on closing a deal that's going to get a fairly significant acquisition fee at the close. So I want to say I'll make almost what I made in a year in this 3 months of just buckling down really hard for a while. So, but I mean, of course I don't say that, but it's just getting to where, seeing the difference that of what the income and the amount of money and the wealth that can be generated and done passively at once you get through that closing time is just very eye-opening. So I my goal at some point is to go, when I worked in one of the major hospitals here in Fort Worth for 10 or 12 years, and just go and visit with some of the guys. There's still quite a few of the people working there that have been working there since so that's another 10 years. So they've been there 20 plus years, and still the same thing. They're punching the clock every morning and going until the day's done. So I'd love to share it with them and help them know that you don't have to have a six-figure physician's salary to get out of the rat race. You can do it with not that PTs are making pretty decent income, but they can, as our nurses, they can definitely pivot into doing this and having more freedom, but they got to have their mindset to want to do it.
Yeah, no, you're absolutely right. It is definitely very much a mindset shift for sure. And it's eye-opening. I think when you first discover this and you first realize this potential, at first there's a lot of hesitancy, right? There's a lot of doubt. There's a lot of concern. I mean, we've been taught and ingrained from the time that we were in grade school to be employees and be dependent on somebody else telling us when we go to work and when we clock in and out, how much we get paid. So it's hard to make that transition if you don't have that entrepreneurial spirit innately. But as you mentioned, man, it's such a powerful tool, and especially once you discover the power of things like apartment syndication and economies of scale, and doing one transaction that could really replace your entire income for the year. That's really it's really a powerful tool that I hope more people discover. And what I'm finding, in particular from healthcare workers, and we'll get off the healthcare path here in just a bit, but what I'm finding is a lot of healthcare workers are getting more and more fatigued. And COVID, I think, really accelerated that fatigue because, again, talking about just the amount of emotional investment and physical investment we put into our work, COVID really took a toll on all healthcare workers, especially at the peak, right? And the hospital systems and these very strict policies, government policies, blah, blah, blah. Here it is 2 years later. We're still hearing it every day. I hear rumblings more and more of healthcare workers just getting really just tired of doing the same old thing. And now they're asking, well, what's next? What can I do next? And so that's why we're here, man. That's why we provide this medium to help educate and expand our horizons. And like I said, man, hopefully open the eyes of people that are looking for, similar transition as you did. So,
Right.
So great message
awesome.
there. Yeah. Great message there. So, all right, Nick, so you started in multifamily real estate, 2015, roughly. You mentioned it took you about a year and a half to get into that first apartment deal, assuming you were still working during that time. Talk to us about that year and a half. When some people hear that, it's important for people to realize when you're making this transition to multifamily, it feels like the world moves really fast, but nothing really moves very fast, right? It takes a lot of time and discipline. So talk to us about that first year and a half and that grind that you went to get to that first deal.
Sure. So 15 was more doing research, due diligence. Then I joined in a program in March of 16 and went through the program. Didn't really start applying myself to probably later in 16. So I'll say fall of 16 is when I really started putting my nose to the grindstone. And it was I was still working full time at the time. Had two younger children. Actually, 16, had a 1-year-old. Didn't even have my second child yet. I'll take that back. Had a 10-year-old and a 6-year-old. I have to get their birthdays right. But anyhow, I had young children, and so I started. I tried to do the training and the education part at night, and would end up falling asleep. So what I had to start doing is just waking up an hour before I was normally got up to go to work. I would do 55 minutes of the training, get some coffee going, sit down, crank through about an hour, 55 minutes, an hour, then get ready and go to work. And then I ended up met another guy, Brad Abbott, who I partnered with on most of my deals. And he and I would get together after our kids. He has children about the same age, say 9 or 9:30. We'd get on the phone and just analyze deals together. We'd sit down and, back then we didn't have Zoom to where we could share screens. There was something called join.me. And I think you got like 15 minutes of shared screen time that you could use for the free version. So we would just talk over the phone like, hey, try this. What about try this and sell, C23? Or you were just both sitting there kind of analyzing deals and working through probably an hour, sometimes 2 or 3 hours a night, 3 or 4 nights a week. But, and then I was in turn getting up at 5 the next morning. So I just went through a stretch of 5-6 hours sleep a night because that is something that I'd set a goal, set my mind that I wanted to do it. And we, being new, we needed to find somebody with some experience. So we, through networking, met another more experienced investor that we just built our relationship with, got to know each other to where we'd be comfortable investing together, and talked to him and said, hey, if we find a deal that looks promising. Would you be interested in investing with us? And he agreed, and so he partnered with us on the first deal. He got a bigger cut. Just he had, as a more experienced person, that first deal is not by any means making me wealthy, but it's throwing off a little cash, but it got my foot in the door to where I just completed my seventh deal, and that was from when the first one closed in February of 16. No, February of 18. Sorry, February of 18 till now. It's under 4 years that I've done 7 syndications at about 1,150 total units between all those. And so just it just until recently I wasn't doing those long 12-hour days, 15-hour days trying to get something done. And and then it took me another probably 4.5 years before I completely phased out of therapy. Being a contract home health therapist, I was able to kind of gradually bring the therapy down as the real estate went up, so I didn't have to quit cold turkey. And and one of the big concerns was what are we going to do with healthcare? But there are other options out there. I think that's a golden handcuff for a lot of people, that they have their healthcare or their benefits, but there are affordable options we found it through a cost sharing program, but there are options that people can take, because that was one of my fears, is moving out, and more made that transition going from a W-2 employee to a 1099. But there are options that are reasonable.
Sure. Yeah. Again, it goes back to the point. It's a pretty intimidating feeling when you talk about transitioning out of that quote unquote security of having that W-2 where you have benefits and everything else that comes with that. But look how well it's paid off for you. Now you're a full-time real estate investor. Not only are you're hopefully you're having a lot of financial success in the development of your business, you probably are getting some amazing tax incentives for being a real estate professional, but now you have control of your schedule and your time. And that's the most important thing. That's the most important commodity. We always talk about that, but I think there is something to be said. And we were just talking about this on a previous episode where when anybody that's listening, that's a W-2 employee that's looking to go down this path of becoming a full-time real estate entrepreneur, you hear often from other industry leaders that, oh, you don't want to invest with people that are not full-time and this and that. And to me, that's such hogwash. And I tell you, because, and what we discussed in our past episode is if you're relying on the income of your real estate business to support you, that's going to not only slow the growth of your business, but that may also affect your ability to make good, sound decisions, right? So the benefit of being a W-2 employee and growing your business is you still have an income stream that you can help cover your home expenses while your business grows, and that will help you make more sound decisions. So I like what you mentioned about, you made that slow transition of, as your real estate portfolio increased, you reduced your W-2 hours, whatnot, but you did that, sounds like over a period of time. And that seems like a very reasonable process to go through.
No, for sure. I was blessed to get that, but even, you made a very good point that somebody that has a W-2 and is doing real estate can focus, or does not have to be a self-focus. They can, like my first deal, I was not looking to replace my income with that deal. I was looking to get my foot in the door. And, we took our sponsor override's only 10%. And we gave half of that to the experienced sponsor and myself, and the other new guy, Brad Abbott, we took the other half. And so, I talk with newer people now, and they're wanting to get a grand slam on their first deal. And I'm like, just tamp it down, go smaller. If the most brokers are not going to give you much attention, if you're looking at an A-class 200 unit property, you've never put a syndication or together or purchased a deal, I would be worried if you got awarded the deal, because it probably means you're overpaying, because the brokers like a surety of close over a price usually. But if it's somebody, usually something that big and new, you're probably looking at a 7-figure non-refundable earnest money day one. So maybe the seller's willing to give you 60 days to try to close it. If not, they get $1 million and then they go to the next guy if they're not in a hurry. So if somebody's new and you're getting a $30 million deal awarded to you, I would wonder why you got it awarded, not somebody that has experience, that's closed deals, maybe with that broker or without, but has some kind of a track record.
Yeah, no, absolutely. You're absolutely right. And we probably don't see it often, but it does happen. And it kind of has you scratching your head like, oh, but what did they just get into? But,
Sure.
hopefully they make it out okay. But, I think you brought up a really good point here talking about that first deal. And this is for both active and passive investors. I think the first one is always the most difficult, right?
Sure.
It's the most time spent studying that analysis paralysis, getting comfortable with just finally making the jump and the leap. And for active investors like you and I, obviously there's a lot of grunt work, in developing that credibility and proving that you can, like you said, have that confidence of surety of closing to your team and the brokers or whatnot. And then for the passive investor, there's a little bit of unsettling as far as, man, I'm about to give this guy $50,000, $100,000, not knowing if I'm going to get it back. And, because
Sure.
ultimately they're investing in you, they're not investing in the deal, they're investing in you. So there's a
100%.
lot of trust that comes with that. So, but after you discover that first one, like you said, the first one, you're not getting rich off that. And even if you make no return, it doesn't matter. It's just about getting your foot in the door. It's about that long-term scalability is what it gets you access to. And that's
Sure.
the focus for you. So you got to, like you said, you got to do what it takes to get in that first one.
For sure.
Yeah. And again, I think it goes for like the same thing for a passive investor too. Eventually you gotta kind of take a leap of faith and find somebody that you trust and make that first investment. And man, once you do, and you realize that, just how this business operates, why would you just stop with one, right? You're just going to want to continue doing it over and over and over. And so continue to go down your path. You got in the first deal 1.5 years after kind of putting in the work. I think you said it was about 10 months before you got in the second one.
Correct. Our
Roughly.
first deal closed in February of 18. Second one is December of 18. A
Okay.
124 unit deal property
Got
win.
it. So the snowball started, the momentum started to build. And I think, like I said, that's roughly around the time we met, 2019. I think you had several deals going. And then all of a sudden this just freight train called COVID comes in 2020 and just really just knocked everybody for a loop. Talk to us a little bit about, where you were at in your business. And then when that started occurring, how did it affect you and how did you guys weather that storm?
Sure. So I said we've had one in February of 18 and then December of 18. Then we had a larger property that we closed in August of 19. We came in and completely painted the exteriors. The clubhouse, they had turned part of the clubhouse into a fitness center. It looked like it was still straight out of the 80s. And so there was also a laundry room on the property, but every unit had a washer and dryer, and the property was making $20 a month on laundry. So the laundry room wasn't even worth keeping. So we opted to shut down the laundry room, move the fitness, like completely gut it, put in a nice fitness center, take the where the fitness center was in the clubhouse, open it up a lot, and put just a ton of work into it. We completed that mid-February or so of 2020. We were going to have a big kickoff, open house, and we have a big TV in there. We're going to have a March Madness, like have all the tenants in there, like food and stuff. Well, COVID hit. That was right around the time all that shut all that down. So that got put on pause. So that was one of the first big things. When it first started happening, we didn't know what was going to happen. So we started running models like, what if we don't collect half our rent? How much cash do we have? How long can we survive? So we immediately stopped distributions just to be safe and started just any money that we're making. We were trying to work with tenants. Anybody that was sick, we were working on. We didn't want to evict, but if it's some people just stopped paying, we were trying to do evictions. And then they had the eviction moratorium that the federal government imposed, which was frustrating because we still had to make our debt payments. We had to pay our electric bill, our water bill, pay our employees, and things like that. So the government's telling people they don't have to pay rent, but we still had to pay our part. And we didn't want handouts. We just wanted, if somebody's sick, let's get them. In the initial payment stimulus that went out for rent and whatnot for people went straight to the tenants. We had several tenants that they were still not coming and paying because they knew we couldn't evict them. And we've gotten most of that cleaned up. We kind of were working with people that were doing the Texas rental relief, trying to get their money in. But, We have started distributions on some of our properties. A couple are still having a bit of a challenge, but we're fighting back to get that where it needs to be. But it didn't end up being as bad as we thought it could be. But it at the same time also has taken off. We're considering listing our properties in the next few months. We're getting broker opinions of values on all of them, just because the demand for multifamily has taken off. A lot of people are wanting to get out of medical or retail, and some of those things that took a really big hit. Most of multifamily didn't, because people will always need a place to live, especially if you're you're investing in the right submarket, which is kind of our first rule is landlord friendly states, or business friendly states, to where you're not going to have as punitive of laws for landlords. And Texas is great, but we still had a period of having to kind of not evict, and then even now with having which we have for Fannie Mae loans, which are federally backed, there's a 30-day, we have to give 30-day notice for notice to vacate before we can evict, instead of the 3-day like Texas. So that's been a bit challenging, because you give notice on the 4th, file for the eviction on the 4th of the next month. Well, they've got another month of rent they owe you at that point, and then if it takes more than 30 days to get them out, then you've got a third month that you owe. So we are seeing a little more on the people that we're evicting. We can end up with 2 or 3 months of bad debt instead of just one, but it's a challenge. We're working through it. It'll get better, but I kind of got off on a tangent. But the demand of people coming and buying, I think we will, we're going to sell these properties at a much lower cap rate than we underwrote for our reversion cap rate, which is going to help recover some of the cash flow that was missed during COVID or due to COVID.
Yeah, it was a really interesting dynamic to watch unfold, right? I think, when you made that first purchase in 2016, probably still one of the arguably the best times to be investing, because there was already, accelerated appreciation in the market after 2016 up until COVID. And then everybody thought COVID was going to be the crash, right? That was going to be the big correction. Everybody kind of took a big breath and said, uh-oh, here it comes. And then every month it was like, okay, collections are still maintaining. And particularly in, like you said, landlord friendly states, people were still maintaining occupancies and in NOI that was covering their debt coverage ratio. And so people were still maintaining. And coming out of COVID, like you said, it was just this bombshell that goes off. And now everybody and their mother wants to be a multifamily investor, right? And so the amount of appreciation that we've seen has just been absolutely incredible. And so very, very good for us as active buyers and active investors, no doubt, for sure. But I think going back to your experience about, through that COVID, I mean, being able to weather that circumstance was a product of two circumstances, in my opinion. Number one, like we said, just the resiliency of the asset class. And, it was really one of the only asset classes that had fiscal policy protecting, both the business owner and the tenants to some degree, right? You had PPP programs that people could take advantage of. You had rental assistance. So it was like one of those only asset classes that really had some level of at least quote unquote protection from the government to make sure that nobody was getting displaced. But two, I think it just speaks to you as the operator as well, being able to recognize like, hey, we need to get into a cash position. We need to make sure that our bank balances are healthy enough to weather this storm, even if we're losing income. And I think that was the really big key driver for a lot of people coming out of COVID, is how they handled it. And those that came out relatively unscathed, like yourself, were people that were, making the right decisions, doing the right thing, taking a very strategic and proactive approach and manage that. So very, kudos to you. Good job on that. And so, and then now look, man, you're in a great position. Tell me a little bit more about, coming out of the COVID pandemic, what you're seeing in the marketplace. It's like you said, you just had 2 big acquisitions here in Houston this year, or in 2021. Is there any surprises that you're seeing right now in this marketplace compared to, maybe pre-COVID?
Surprises. The volume of transactions is surprising. There's a lot going on. Like you mentioned, I've done 2. We closed 2 at the end of close to the end. One in September, one in December in Houston, and then also I was part of another property that closed in Dallas in September. So I had deals closed 10 days apart in September, which was exciting. At one point, they were both going to close on the same day, which I was kind of hoping to be able to brag about that, but they just, things moved with just COVID, things are slower to close. But, coming out, it just, how it went from almost just sputtering along to just blasting off with deals that are out there, deals that still underwrite. One thing, if you look, one reason I'm big on Houston is it depends on what data you're looking at, but Houston is projected to be anywhere from 1 to 3 largest population growth in the next 5 and 10 years. So, and at the same time, they're way behind on some product. So there's fewer rental unit or not only rental units, but also units of homes to buy. So there's fewer places for people to live than should be coming into the market. And then you throw on top of that people are moving here for whatever reason from denser populated states, for states that may have, I'm trying to say this politically correct, but rules that are not as favorable to business or freedom. And so people are coming to Texas by the droves from the West Coast and the Northeast. And so it's just pushing that population up. And Dallas isn't too far behind. It depends. You probably could make a good argument for Dallas or Houston, either one. But Dallas does have more deliveries coming, so they're keeping up with their supply better than Houston has. But I think both are great places. Really kind of the Southeast. You think of the Sun Belt all the way to Arizona, or places where people are moving in large numbers, and so that's going to keep lifting those rents up and lifting the demand, because they're going. I think you go kind of along the same path that we do. We're not buying these for super long holds. We're looking 3 to 5 years to turn them and then leave some meat on the bone for the next buyer to be able to come in and implement their plan. And, just because you start getting longer out there, that time period, you don't have your CapEx dollars that you brought in either from your capital raise or from the lender. And as things start to break, that's when it's time to maybe move on to let the next buyer come in.
Well, let me ask you to that point, because that's a really good point, because we've had a little bit of shift in our investing thesis over the past, 18 months or so. To your point about, we're seeing this extreme cap rate compression. We're seeing a high demand, as you mentioned, a lot of liquidity coming into multifamily from all different sectors. In places like Texas, which we're very fortunate to be in, but it's also equally as frustrating, because used to you'd be one of 10 offers. Now you're one of like 30 or 40.
Sure.
The best and final rounds are 10 and 12 deep every time. So it's insane. But nonetheless, everything is basically trading on a premium. Now that you've have a few assets here in Houston, right? The value add deals, the 70s product is trading at a 4.5 cap, and that's just a very small spread between your A-class deals selling at a 4 cap, and has your thesis changed at all because of that accelerated appreciation across all asset classes, C class or A class? Have you made a pivot or changed your strategy to maybe go towards a different type of asset class, or are you sticking with the same?
I'm looking more at 80s. I'm not quite sure that I'm ready to move into that 2000, 2020, brand new stuff. I'm not opposed to it, but I still don't know, that would be a larger capital raise, most of them, than I'm comfortable with right now. So that's part of the reason. But I agree with you on the cap rates. You're buying, especially a B, very close to what you're getting a C class property on for your cap rate. And and there's concern that our cap rate's going to creep up. We build in, our reversion cap rate or our sales cap rate is, we try to come above what the current. Not necessarily what we're buying, definitely what we're buying it for, but also what things are selling for in the market. Say, like you said, in Houston, a C class is a 4.5. We'd probably underwrite selling at a 4.75 or a 5, just to have that cushion, because as interest rates start coming up, who knows what's going to happen. But you could make the counter argument that as long as people are moving to Houston or Dallas, whatever these markets are, it's going to push rents up. Is it going to be like, are we going to have LA rents, in 5, 10, or 20 years? And if rents keep growing, then the cap rates could be held down. And with inflation, just you have this property and really nothing else happens, but just from inflation, you have a hard asset that's going to appreciate in value over time as inflation. If your money's sitting in the bank, it's buying tomorrow. You're going to be able to buy less with it tomorrow than you are today. But
Yeah.
but this apartment or real estate, some type of hard asset's going to be growing along with the inflation.
Yeah, it's interesting. Not to pick on our fundamentalists out there, if you compare where we're looking and analyzing deals now versus 2 years ago, to your point about like the reversion cap, for example, you typically have a 150, 200 basis point spread on your reversion, right? And that's your conservative assumption. Well, now, like you said, 25, 50 is kind of like that's about as far as you're going to go. But I think for the fundamentalists out there, they'll look at that and they're scratching their heads wondering how we can make sense of that. But as you're alluding to, man, there's so many dynamic factors that are playing into what we're seeing in the marketplace right now. The supply and demand imbalance is incredible. I mean, we are really in a critical housing shortage. Development is not keeping up with pace at all. And the input costs of developments are further driving, that appreciation. And so, and then, like you said, you take into the migratory patterns, the things that we're seeing, the liquidity, the demand. I mean, all these factors that are playing in that are further fueling the longevity, I think, of what we're seeing in the multifamily space. So, along that same vein, Nic, let's go ahead and whip out your crystal ball. Tell us, in your own opinion, what do you see happening over the next 3 to 5 years in multifamily?
I think just evidence of my purchases, I see it continuing to grow. It's people are, especially it's COVID restrictions, in some of these more densely populated states or cities, and more restrictive rules are going to push people to less restrictive states, and they're going to see that the economy is still going. I think people and the Northeast or the West Coast I don't even know if they realize how much more free we're living here. Not how much less restricted. Just my children's school, we go to a smaller private school that we had 3 kids transfer from California over Christmas just because their families like, we're done with the 3 different families, not 3 kids from one family and not related. They're like, and that's just a small school in Fort Worth that had, and I'm sure that's going on all across the Sun Belt or, states that are not locking down just because they wanted to get away from the repetitive restrictions and some of the stuff that's going on. And so with that continued immigration into the state or population shift, it's going to keep pressure, especially looking at 70s and 80s product. You can't build it. You can't build. It's too construction costs are well above purchase costs, although they're getting close. It's still not there. I think last I heard it's, and this has been a few months ago, that new construction is about $250,000 a unit. And the deal we just closed in Houston was a mid 80s property we got for somewhere in the mid 80s purchase price. And so, there's no way we can get to that same point. You couldn't build something in that neighborhood and target the workforce housing. We're targeting tenants that are making $40,000-$50,000 a year with that property. We have another one that was in the Med Center in Houston, and we're targeting a different demographic, and we paid quite a bit more for it. But it's still just the price of the land there in the Med Center in Houston is if somebody wanted to build something there, they're going to build an A class. It's just you could just to buy the land is too cost prohibitive to come in and put workforce. Now that's a mid 80s property too, and we're positioning it as an affordable option to all the A class stuff that's going up around it. And we're just being in the Med Center. There's a bigger demand for furnished units, so we're in the process of furnishing at least 10% of our units, and some of them we're going to rent for. We have residents that are coming for trainings, physicians or traveling nurses. We also have a lot of people in the Houston Med Center that come from all over the world for treatments, and they need a place to stay. And so we're setting that up. We're supposed to have 3 units being furnished as we're speaking right now. So that was a pivot that we've never done before at any other, because most of your properties are not looking for furnished units, but it's just a niche there in the Med Center. I think it maybe in a core district, it's in a more central area, you could have even some work travelers or corporate units set up, but our focus is going to be towards medical, either professionals or families that are there for treatment, or while their loved one or family member is in the hospital or for some treatment, the family needs a nice furnished place to stay.
Sure, sure. We didn't get a chance to talk about this before the show, Nic, but I actually looked at that asset as well, and yeah, it's a superb location right there next to the medical center here in Houston. Phenomenal location, really cool asset too. I think it's got a really cool story. I think it was a previous conversion and all that good stuff.
Yeah, it was I don't know if it was an Econo Lodge, some type of like extended stay type hotel that the developer converted. We actually come into a couple of units I think still have the original carpet from the hotel days. Like, woo, this is definitely a very, very old carpet in here. So, but it's good. It's good opportunity for us.
Yeah. It was probably one of those like true traditional value add opportunities where you can go in there and make some upgrades and actually really force that value injection, which is, as you know, right, is with syndication being what it is, a lot of these multifamily products has been traded hand over hand, every 2-3 years. And so everybody's been implementing a value add. So a lot of the value add plays have really been kind of harder to find. Absolutely. So, well, Nic, we're kind of getting almost near the end of our time, but before we kind of get to our final four here, I want to give an opportunity to kind of appeal to some of our passive investors that may be listening. It sounds like, I know you've got assets all across Texas, everywhere from, like you said, Abilene, Houston, Dallas. You got a property in Colorado as a passive investor. But, looking at your portfolio, are you primarily focused just here in Texas now? I mean, what's your core thesis there?
I'm considering branching out if I can find a partner that can be a local boots on the ground. But I live in Texas, so it's one of the better places to invest, if not the best. So I don't see any reason to, other than why fly when I don't have to? I can still drive to Houston and back in a day. It's a bit of a haul, but I can get down and see. I did it Monday of this week. I drove down and saw both properties, and spent a little time on both of them, and made it back home by 6 o'clock in the evening or so. I did leave at 5 or so in the morning, but you're able to get down there and get back in a reasonable time. And you start looking at, I'd love to do something in Florida, Georgia, Alabama, even Arizona. And then maybe even Tennessee or the Carolinas, I think all have opportunity, but not having. I've developed a few local contacts in those spots, so it's something I would consider. But again, if it's something I'm going after with just me and my partners that I have now, that's staying right here in our backyard is much easier than having to hop on a plane to go take care of things.
Yeah. Like I said, we're blessed to be located where we're at here in these markets for sure. And it's nice to be able to be in the backyard of such a desirable investment market. So, Nic, when we talk about from a passive investor perspective, when it comes to the sponsor, that's the most important part of the deal, in our opinion, right? It's the one that you're putting your trust in to protect your capital. And so, when we talk about vetting the sponsor, there's making sure that you have the experience, making sure that you've kind of gone through some downturns or some tough times to kind of show that you're battle tested, so to speak. And then, there's being in great markets and having an alignment of investing interest and thesis. So, man, you check all those boxes. And so is there anything else that you would like to highlight as far as your career that, would be a reason why people would want to get connected with you?
Well, the bullet points you hit on, we've had one property that's had challenges. I've learned a lot from that one. And so that's good. But, one thing I consider too, when you're looking at investing with somebody, is do they have a decent amount of capital? If challenges break out at a property, can they come in and cover some costs, or to where they're not going to need to do a capital call? No one wants to do a capital call, but, having a sponsorship team that has some, a liquidity in the bank to be able to cover something, that was something we were worried about going through COVID is, what if we hit a point where we're not covering, we've burned through our cash. What kind of cash do we, ask the sponsorship group, have in our pocket? And that was early on in COVID. We saw that we didn't need there, but, knowing that we had other capital we could bring to the table if we had to. It's not something we wanted to do, but, before we had to file for not an abatement, it's before we had to ask the lender to let us skip a payment or two. We it's like, all right, we got money in the bank, to our personal bank, personal or business accounts, that we can come in and help the property. We didn't end up having to go that route during COVID, but it's during the middle of it. But that I think is a something to check with your sponsors. Can they cover something because if you buy enough properties, you're going to have a challenge at one. If you get it, if you end up with 10 or 20, something crazy. It could be a fire, a windstorm, something that unexpected. Unless you're extremely lucky, and I don't really believe in luck too much. The odds are going to catch up with you eventually. So, but having now worked on we just completed our 7th. So having the experience to do that, getting a team around you, I have myself and Brad Abbott have done one. We've got another partner we've been working with, Mo, down in Houston, has a close relationship with this property management company, being involved in that, making sure your sponsors are good communicators. How often are they going to be sending out updates? One thing I tell newer people too is when you ask some questions when you're looking to invest in a deal, and if the people do not respond to you in a relatively timely manner, or they seem annoyed that you're asking questions, I'd probably go somewhere else, because they're trying to get your money. Once they have your money, they're definitely not going to get any better at communicating. Once the deal closes, because when they're trying to air quotes win your business, when you're get you to invest with them, and they're not doing a good job of communicating, I would tap the brakes on giving them my money.
Man, that's such a great point. Authenticity is such an important thing when it comes to developing that trust and that relationship, for sure. And you want people that are genuine and not out, just like you said, you got to take the approach of, listen, whether you invest with me or not doesn't matter. It's about you, the person. It's about protecting that integrity of the relationship. So I agree with that 100%. Wholeheartedly. Well, Nic, man, this has been a great conversation, but this has been awesome, and I appreciate you coming on. We got a few more questions for you before we wrap up, and then we'll wrap up here. But Nic, one thing that we do like to know from all of our guests on the show is, what do you like to do for your own continued education to further your investing?
I read almost daily, and not always real estate books, just personal development, even health or exercise. Attend conferences. I'm also part of a mastermind that works on branding, relationship building, just goal setting, things like that to help stretch. Also, I guess that's for my real estate world, and just personal development. Also involved, try to exercise 4 or 5 days a week. I'm a part of a men's group that we meet every Monday. At least you want to meet Monday through Friday at 5:30 in the morning, done at 6:15, and then it's a nationwide group. Then they also meet on Saturdays. Our Fort Worth group meets from 6:30 to 7:30 on Saturdays, but it's called F3 Nation. If anybody, it's men only, but it's free. It's peer led. Great. It stands for faith, fellowship, and fitness. So they get together. There's several in Houston. I know Dallas, Fort Worth, but most major cities have them. But it's free. It's been a great. I got up this morning. We actually, Thursdays are a ruck day. We ruck from 5 to 6:30. Did a 5-mile ruck this morning. So just meet at different locations throughout the city. So I think it's important to get up and push yourself, do something challenging. If possibly first thing in the morning. Right now it's wind chill was in the probably upper teens this morning. And I thought about staying in my bed, keeping warm, but it's like, no, I've got to. And we have a system where you commit the night before. So I'm like, I committed. I'm going to get a hard time if I don't show up. So I went ahead, got up and got out there, and I'm glad I did it.
That's awesome, man. I'm going to check that out. That's really cool, especially those couple here using.
Yeah, I know there's several there. So I'll send you the link, but just F3, like Frank, Faith, Fitness, Fellowship, and the letter 3.
Cool, man. Yeah, definitely looking forward to checking that out. So I appreciate that. So
you bet.
Well, Nic, looking back at your history and your trajectory, I mean, what was that one moment of time or one event that really changed the course of your trajectory?
Getting my first deal. Well, I think deciding I was going to buckle down. I joined an education group, which I had to write a pretty substantial check, and I've made that multifold over back. But that motivated me to, I've got to apply myself, or I'm wasting this money. But getting the first deal to close, I kind of missed that excitement. We closed the deal December 31st, and I was excited about it. But I remember we closed the first one. It's like you wanted to jump up and down and celebrate. And, this one's like, all right, got another one. And, but I was like, I kind of miss, but it's also being around, I'm still part of the real estate group. Seeing other new people get their first deal and just seeing that excitement and, knowing that what they're feeling. So, but I think it was getting the first one, seeing how much money that was going to make other people, and then starting to get second, third, fourth, on down opportunities. And it still amazes me that I will talk to people about investing $250,000 in deals. And, not too long ago was working as a physical therapist, wanting $65 a treatment was what I was, the dollars that I was dealing in. So it's I'm blessed to be where I'm at. It's hard work, but also I think it's a blessing. But anybody can do it. I coming from a PT background, and had my wife and I bought the two homes we lived in. Really done no real estate investing, but through applying myself, it can be done on your own. But you can also do it with a mentorship type program. But you can just get out and do it and apply yourself consistently on a near daily basis. Same with fitness or anything you want to train to do. I keep telling myself I'm going to learn to play the guitar, but I got to buy a guitar first. But problem is I have no musical talent at all. So I don't know if it's, but I could at least learn to play some simple songs.
Yeah, absolutely. Like you said, man, you put your mind to it, you can do really anything. So,
sure.
Well, on that same vein there, Nic, what would be some advice you'd give to listeners to help them grow their business?
If you're wanting in multifamily business, well, one is just find some type of education and apply it. Find a book, and I wouldn't just blindly go to the bookstore and buy something, but reach out to other people, find people that have done what you're wanting to do, and you've seen them do it, and then go and ask them if you can. Tell them, follow them around, or talk with them, ask what they did. It's success leaves clues. So following someone else, that's how I got here is through a mentorship program that, we just repeat it's not rocket science. It's when you get down to it, the analyzer's fairly complicated, but it's a series of steps that multiple people have done and done successfully. So there's no reason to go through the full learning process and get beat up. Find somebody that's done it and work with them.
Absolutely. Great advice, Nic. Really appreciate that. So, all right, man, tell listeners how they can learn more about you and get connected with you.
Sure, Cody. First of all, thanks for having me on. I appreciate it. It's great getting to know you a little better. But my website is thrivemultifamily.com. So it's THRIVE multifamily.com. And there is you can put in your information there, and there's a Calendly link, or you can email me at Nic at Thrive Multifamily, and there's no K in Nic, so NIC at thrivemultifamily.com.
Well, Nic, I want to thank you so much for coming on the show, man. It's been a great conversation. Really enjoyed getting to know you over this past several years, and congratulations on all the success thus far. And definitely look forward to staying connected. So
you bet. Appreciate it.
Awesome. Thanks, man.
Thank you.